My name is Matthew Bell. Today I want to talk just a little bit about some of the basic definitions that you might encounter in talking about retirement planning. I'm not an expert. I'm not going to be giving you today, I'm not a tax preparer. I'm not going to give you tax advice. I'm not giving you retirement planning advice. I'm not going to be giving you financial advice of any kind. I'm not a lawyer. This is not legal advice. What this is an attempt to create a kind of a resource that I had wanted to have myself early on and didn't locate it. I wasn't able to locate the kind of a resource where I would actually be able to get a fix on certain basic terms. Many cases, when I would Google various terms of this kind online, the kinds of information that I got seemed to assume that you had a basic understanding of the terminology. So as I talk with my mom, for instance, my dad passed in 2016, and his financial situation was bad. He had to go through a Medicaid spend down, and that affected my mom's retirement plans. As I'm thinking about retirement, as I'm talking with my kids about retirement, planning for their future retirement, there are a number of basic terms that it is well to have a basic familiarity with. Now, there is a learning curve, so this kind of resource, I feel like, is going to maybe help to make the curve not be quite as steep as it might have been otherwise, but there still is going to be a period of adjustment when you're trying to learn some of these terms. Now, the first term that I want to discuss is just what is a retirement plan, and there are actually a couple of different meanings for this. One of them seems to be current in everyday speech, but isn't necessarily the most relevant to the actual conversation that we're going to be having going forward. But let's just get that one out of the way. So in that case, a retirement plan is simply your idea of what you are going to be doing in the future. How much money are you going to need? How much money are you going to spend? And in this regard, a retirement plan is basically just like your plan for the weekend. What are you going to do? How much money you're going to need? It's just basically, have you had that kind of discussion with financial planners, with insurance people, with your relatives? So in that sense, a financial plan, it just means look forward to that future time when you are going to be in retirement. The second kind of retirement plan, and the one that's much more pertinent for actual planning purposes, is going to be a retirement plan is a vehicle or an account into which you are going to put money, and you're going to try and grow that money for future use. So future use when you are no longer having an active stream of income because you're no longer working at your 9-to-5 job, let's say, that is what we mean by a retirement plan. So it's going to be some kind of a vehicle that you're going to put money into now in the hopes of having money available to you in the future to use when you're no longer actively working at your job. Now, why is this kind of a retirement plan necessary? Well, number one is, and the most basic reason is, that you have mortgage, utilities, groceries, the basic expenses of life. It costs money to live. And if you reach an age where you either want to retire, or that is to say you want to quit working, or you are forced to quit working, maybe because of layoffs, maybe because of some sort of disability or illness, you reach a point during which you either want to stop working or must stop working. How are you going to afford the basic necessities of life is the basic question. And so a retirement plan is designed to put something in place so that at some future time when you are no longer actively working, you're still going to be able to support yourself. Now, there's a couple of types of plans. The first distinction that we'll go over is the difference between an employer-sponsored plan and one that's not employer-sponsored. Basically, employer-sponsored just means you have to go through a place of work, a business, your employer, in order to get the plan. So a 401k is this kind of a plan. You have access to it through your employer. Other kinds of retirement plans, for example, a Roth IRA, you don't have to go through an employer. You can get them on your own as an individual. Retirement plans also could be either defined contribution or defined benefit plans. Now, let's break those two words down. So first of all, to define something is simply to specify what it is, and that's what we mean here, to specify what it is. Now, in a retirement plan, we just said that you would put money away now in order to potentially have it available to you at a later time during your retirement, okay? So when you think of it, think of the money that goes in as your contribution and the money that comes out as your benefit amount. So if we think of it that way, money goes in as the contribution, the money that goes out is your benefit, then there are two kinds of employer plans. One of them is defined contribution and one is defined benefit, depending on which of those things we want to specify and guarantee. Okay, so here's the basic idea. Is in the past, employers had defined benefit plans, and what those defined benefit plans looked like a pension. And what a pension was if you had a certain amount of service at a certain income level, then your employer would guarantee you a certain amount going out towards you in retirement. So let's say you made $100,000, you worked at a company for 25 years, and your pension benefit guaranteed you 85% of that income in retirement. That is a defined benefit pension plan. Now, pension plans are going the way of the dinosaur, right? So most employers today don't have defined benefit plan, they have a defined contribution plan. Defined contribution plan means that the employer is not going to guarantee what goes out, they will guarantee rather what they put in to the plan. Most of these guarantees are going to be conditional. So for example, they're going to say, if you put in a certain amount, then we'll put in a certain amount too, and we'll get to that in just a moment. But just to make sure that the point is clear, a contribution is essentially the money that's put into a plan. Now, the contribution, you can think of it as something like a deposit that you might make into a savings account, for example. Now, 401k and other retirement plans are different, and you don't have the same rights of ownership in those plans that you would, let's say, if you opened a savings account in your own name. If you open a savings account in your own name and you make a deposit into that account, you've got certain rights over that money, you can withdraw it, and so on. In a retirement plan, there are going to be certain rules regarding how much of the money you can access, when you can access it, the rules around how to access it, and so on. And so the accounts are set up differently, but on the most basic level, if a contribution is the amount you put in, you can think of it in a way like making a deposit into a savings account. Now, another distinction in retirement plans besides defined contribution, defined benefit, and besides employer-sponsored versus non-employer-sponsored is going to be the distinction between a tax-qualified plan and a non-qualified plan. Now, all qualification means in this case is that there's some special agreement with Uncle Sam, some special arrangement with the government, and in particular with the Internal Revenue Service. So in a tax-qualified plan, it means that there are certain special rules that attend to that particular vehicle. Certain rules regarding contributions, taking money, putting money in, taking money out, rules around when you can access it, and the like of this. Non-qualified means that there is not this special arrangement. Usually people think of the idea of being tax qualified as having some kind of a tax favored status. So it's not regular rules that apply, it's special rules. So if regular rules apply, it's non-qualified. If special rules apply, then we call it tax qualified. Tax qualified plans include 401k, traditional IRA, and the like of these. Now, when you are making contributions into your 401k, generally speaking, we think of these as what are called elective deferrals. That is to say, you take a certain amount of money that you would have received as regular income and you push it over into your retirement account, an elective deferral. There are benefit plans and contribution plans where the employer puts in money regardless of whether you do or not, but in this case, in the conversation that we're basically going to be having moving forward, we're talking about mostly plans that you yourself will be able to contribute to, and in that case, this idea of an elective deferral is an important one, since the basic idea is that it's money that you are entitled to since it's part of your wages or your salary, but you've elected to defer taking that money until a later time. So you're putting it into an account where you're not touching that money now. Another concept that is important for retirement plans is going to be the idea of a match. So a match basically is the amount of money that your employer will put in if you put a certain amount in yourself. Now, once again, sometimes employers will put money in whether or not you do, but most of the time, if the employer is going to put money in, you're going to have to put in money first. Now, this could be almost anything. It could be dollar for dollar. If you put in $1, they'll match you $1. But most of the time, this is going to be a certain percentage up to a certain limit, and the employer will have something in place like this, where if you put in 6%, they'll put in 4%. They'll match you 4% on 6. Or if you put in 3, they'll put in 1.5. Or if you put in 8, they'll put in 6. Okay. Now, it can be different. You're going to have to contact the plan administrator or your human resource or benefit department in order to be able to tell for sure what the requirements and what the rules are for your particular case, but this is in general how it works. Now, just very basically, what does it mean to put in 6%? Okay, well, let's take an easy example. And please understand that in me using these examples, I'm going to have to abstract away from a lot of things, or at least I'm going to choose to do this. I'm going to take very simple examples, ones that may not map onto real world examples. I'm going to forget about certain things like cost of living. We're going to forget about certain things like the standard deduction for tax purposes, and we're just going to kind of try and work with basic numbers to get a handle on the basic concepts. And then you'll have to understand that there's additional detail that is sometimes that goes along with these things. So for example, if a person is making $100,000 and they contribute 6%, then they're contributing 6% of $100,000, or $6,000 in this case. So if your employer matches 4% when you put in 6% and you're making $100,000, that means if you put in 6,000, they will put in 4,000, giving you a total of 10,000. That's basically the way that a match works. Another important and related concept is going to be that of vesting, right? So what does it mean to be vested? Vesting has to do with ownership or with securing possession of something. So if you are vested in an account, then that means you have full ownership rights over that account. This is, again, where I say there's a difference between a retirement account and a savings account. When you have a savings account, you're vested in the money you put into that account. There's no additional rules or regulations generally on you being able to access that money. But in a retirement account, the retirement account is basically like a trustee account. When somebody says they have a 401k or I opened a 401k, it's not the same kind of thing as if they were to open a savings account. What happens is there is an account that is set up for the benefit of that employee. However, there are certain rules on accessing money, contributing money, and things that wouldn't apply to other kinds of accounts. So here's an example, investing, right? So in some cases, when you start with an employer, you might have to wait a period of time before you can even contribute to a 401k. It might not be available to you right off the bat. But once it is available to you, let's suppose in the case that we already named, you're making $100,000, you contribute 6%, and your employer will match 4%. The question of vesting here is how much of that $10,000 do you actually own? Now, usually, most cases that I have run across so far, you've got a 401k kind of situation where you yourself are putting in $6,000. You are vested in that from day one. And the reason for that generally is that, again, it is an elective deferral. That $6,000 came from a paycheck that you were owed, that you decided to not take right now, but have decided to put it off to the side for use later on. So that money is yours. Generally speaking, that money is yours. You're vested in it from day one. The employer match, on the other hand, you may or may not be vested in it from day one. Oftentimes, employers will put service requirements on how long you have to be with an employer before you have full ownership of the amounts they put in. So in the case, let's say you've worked for a company for 2 years, you put in 6,000, they put in 4. It might be that if you were to sever employment ties, if you were to be laid off or be terminated or for some other reason quit, that you would be able to take your 6,000 with you, but the 4,000 the employer put in may stay. And if that's the case, then you're not vested in it. Sometimes there are vesting requirements or vesting levels. So for example, at 5 years of employment, maybe you're 100% vested in the employer contribution. So vesting means how much of the money in the account do you have ownership rights over. Again, contact your plan administrators to try and get a fix on what your vesting requirements are for your particular case. Another concept that's relevant here is going to be the idea of a tax deduction. So tax deductibility is an important thing when we're talking about retirement accounts. And when we talk about accounts being tax qualified, or as I said, there are normal rules and there are special rules. Well, in a lot of cases, the special rules include certain privileges or favors, and so some people refer to these plans as tax favored or tax preferred. And what that basically has to do with is a number of things, but one of them is sometimes tax deductibility. Okay, so if an employer, if a retirement plan is tax deductible, then that means that the contributions that you put into that plan are able to be used as tax deductions in whatever year you put them in. So what does that mean? So if you don't have a background in taxes like I didn't, this kind of conversation might be helpful. It's very basic and again, I'm not a tax preparer. You have to consult with a tax preparer. I'm going to make certain assumptions that will probably irritate people who are fully well versed in these topics. But let's consider a person who is making $100,000. Again, we're going to forget about the standard deduction. I'm going to forget about income tax brackets the way they actually exist in our country right now. And let's just say this. When you ask yourself, how much tax do I owe? It's going to be a function of what your income is and what your tax rate is. At its basic level, that is the calculation that is used. Now, finding your income level and putting you in a tax bracket is a complicated thing that has to do with a lot of different moving pieces, including deductions and business expenses and the like of this. But let's just suppose this person's making $100,000, and let's pretend that they're in the 10% bracket to make the math easy. Okay, so if that's the case, then $100,000 times 10% gives us the amount of taxes they're going to owe, $10,000. 100,000 times 10%, $10,000. Now, let's suppose that they make a contribution in that tax year to their 401k. So they've put in, and we'll just use the example from before, let's say they put in $6,000 of their money, elective deferral, into their 401k. To be a tax deduction basically means that when they calculate the amount of money that they're going to multiply by their tax rate, they're going to take their original $100,000 and subtract the amount that they put into their 401k. So now $100,000 minus $6,000 is $94,000. So $100,000 minus the $6,000 that they get a deduction for brings them to what's called an adjusted gross income. So their gross income was $100,000. Their contribution to the 401k was $6,000, and they get a tax deduction for it. So they subtract the $6,000 from their gross income and arrive at a figure that is called the adjusted gross income. Now it's that figure that gets multiplied by their tax rate. So if we again pretend that they're in the 10% bracket, probably wouldn't be, but let's pretend, then it would be $94,000 times 10%, which is $9,400. So in other words, if the same person making $100,000 would pay $10,000 in taxes without a 401k contribution, and with the 401k contribution, all other things being equal, they would pay $9,400, or they would pay $600 less in tax if they put $6,000 into their 401k. So their $6,000 tax, their $6,000 contribution was worth a $6,000 deduction, which ended up being worth $600 in tax savings. $6,000 and $600. So $600 of tax savings on $6,000 contribution, that's again 10%, and that was because they're in the 10% bracket. Now in some cases it is advantageous to try to get those deductions and to lessen the amount of income tax that you have. So that's one of the benefits of having a 401k or a tax qualified plan in this way. Now there's also a similar idea of tax deferral, and what tax deferral basically means is that you would push down the road. You would kick your tax burden like a can. You're kicking the can down the road. You're going to deal with it later. So to defer taxes means you're not going to pay them now. You're going to pay them later. Now, if you're talking about a 401k and you have elected to defer a certain amount of your salary into your 401k or your wages, say $6,000, you're not paying taxes on it this year. That means that you don't. It doesn't mean that you don't ever have to pay taxes. It just means that you are going to kick that tax burden down the road. You're going to pay the taxes on that later. In addition to that, the money in the 401k is not like it's stuffed in a mattress somewhere or left in a tin can and buried in the yard, right? That is going to be placed into some vehicle, and that vehicle, wherever it is, may have the ability to earn certain, to accumulate earnings, right? Now, whether they do or not is going to depend on the market, it's going to depend on the interest rate environment, it's going to depend on the selections that you make in terms of how you allocate funds, how well if you invest in mutual funds or index funds, how well those funds do. There's all kinds of stuff that's going to make a difference as to whether or not you actually see earnings. But in a 401k, it's at least in principle possible that the money you put in is going to earn something, so that the money you put in is going to grow between the time you put it in and the time you take it out. So in a tax situation, you're going to owe tax not just on the money you put in, but on the amount of earnings that that account accumulates over the time that it's in the account. But in a 401k or in a tax qualified plan, the earnings are tax deferred. Now this is in contradistinction to something like a CD, where you would pay taxes every year on the interest, for example. So if you have an interest-bearing CD and you, let's say you have $10,000 in a CD and you make $100, you're going to get a 1099 form at the end of the year for your taxes, and you're going to have to report that you made $100 on that CD. Whether you pay taxes on it or not, in principle or in practice, is going to matter in terms of whether, in terms of your income level and your tax bracket. But in principle, everything that you are making on that CD is going to be taxable, and it's taxable generally the year that you make it. This is, again, in contradistinction to a qualified retirement plan where you're going to push your earnings, you're going to push the tax liability down the road so that you're going to pay tax on that money later on. Now, one basic term that I've neglected up to this time has been the term distribution. So I've said benefit is the amount that comes out, but another word for it is going to be the distribution. So a distribution is going to be when you withdraw money, basically, from a retirement account. Now, in some cases with retirement accounts, the money that you withdraw is going to be taxable. And we just looked at a case like that, where if you have a 401k and you've never been taxed on the money going in, and it earns something over the years, when you take a distribution, when you start taking money out of that account in retirement, you're going to be taxed on everything. Now, other accounts are going to work differently. A Roth IRA, for example, works differently, and I will get into detail on those. This is not the place for that. I feel like this is just the basic definitions, but in a future video, I will describe in greater detail some of the inner workings as to how that functions and some of the differences in terms of that. But can suffice it to say that a contribution is what goes in, the distribution or the benefit is what comes out. So once again, there's a difference between earnings in an account and the principal. So whatever you put in is sometimes referred to as the principal, and whatever amount is added to that in virtue of a positive investment experience or a good interest rate return, then you would call that earnings. Now, it's possible that your money could lose, that you could actually lose some of your principal, and in that case, we would call it a loss. If the amount of the money in your account goes up, we call it a gain. If the amount goes down, we call it a loss. Now, in addition to that, you'll sometimes hear investors and people talk about realizing a loss or actualizing it. And essentially what this means is that, if you have a certain amount of money, and let's use a casino example. So you put $1 into the slot machine and you pull the lever and you get 20 cents. Well, that 20 cents is an earning, but it's not realized, it's not real, let's say, until you cash out. If you take your slip from the machine and go over to the teller window, you could get $1.20. But if you keep pulling the lever, there's a possibility that that amount is going to go down, possibility it'll go up again as well. But what we mean by realization essentially is cashing out. So if you realize a gain, that is to say, if you have $100,000 in a particular account and you gain $20,000 and you cash out, that is realizing the gain. Now, on the other hand, if you have $100,000 and you lose 20 and you're down at 80, they call that realizing a loss. Now, whether there's a loss or a gain is going to affect your tax situation, but these are some of the words that you might expect to hear in conversations about these accounts. And again, taxation is its own separate animal. We'll kind of deal with that in future videos. So for the time being, I've gone through, I guess, about 15 or so terms that were somewhat confusing and perplexing to me, or terms that came up in conversation with my family members, my mom, my kids, other people that I've talked with about retirement. And sometimes these terms can give people a problem because they're not terms maybe that you're familiar with in everyday speech. So I hope that something that I said here has been of value to you, and basically I hope to build on the terminology that I have gone over in this video. I hope to build on that so that in future videos we can talk about higher level concepts, and then I can just say, hey, if you are in need of a refresher on some of these terms, please go back and see this video. I hope it has been helpful for you. I know it's said that a presenter benefits most in a situation because the presenter has to prepare and make sure he or she really has an understanding. And so as I work towards that kind of understanding, this kind of thing is helpful for me. I hope it has been helpful for you. If it has been, I would please ask you to like the video, subscribe to the channel, check it out, because I'm going to have future discussions of other related topics. And in the meantime, I wish you well and happy retirement planning.